Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I have Anthony Danaher, President, Portfolio Manager, Guild Investment Management. Tony, welcome to the show.
Well, thank you for having me, and good day to everybody out there.
All right, I'm glad you're here. Tony, you've got 45 years plus of investment knowledge and experience in stocks, bonds, currencies. Let's start this off. What is going on, in your opinion, right now with the U.S. market, U.S. economy?
Well, the U.S. market and the U.S. economy are both attached at the hip. Yes. Earnings in the U.S. Corporate business cycle are quite strong. That's driving people into equities. And it's all a function of a U.S. economy that's stronger than most people have thought possible. And I would credit tax and regulatory changes for that strength and for that trickling through to the earnings growth. And when people see earnings, they tend to look for how they can benefit from those earnings, and stocks are the clearest way to benefit.
Now, there's been some back and forth about some things that the current administration has done to really help goose that up a little bit, one of which would be the statement that there is going to be trade wars. People are trying to get in ahead of it. I was talking to somebody at a car dealership, a European car dealership, and they're saying, look, our prices are going to double next year if this trade war actually does take place, steel, what have you. Are you seeing that this is just adding on top of that to fuel the fire for equities being one of the best places for people to invest their money, not necessarily trade it, but invest their money?
Well, I see the trade war as an addressing of an imbalanced trade situation that's existed for decades. And in correcting that, it's creating some pain. But what I would argue is that with the trade negotiations, and I do view them as negotiations, I think we're getting to the point where it's not yet a trade war. It's a long, protracted negotiation that could, and I think people believe this, that could actually make for some long-term benefits to the U.S. economy and to the global economy. If this really puts the idea of tariffs and trade restrictions under the microscope to see how good they are. Now, granted, you're using tariffs to fight tariffs does not make sense in that, but longer term, if we get more open, free trade, then the most competitive economies will continue to benefit more than the less competitive economies. And I do view that as a long-term positive.
So with everything you said so far, the way I'm looking at it at this point is that the administration's policies, the way that the market is set up right now, the new injection of funds, whether it's from the cryptocurrency ICOs having to put the money somewhere, this is turning into no longer the thought of maybe we'll plateau out here, but we could have another leg up that could last for a little while longer. Am I reading the cards right with you on that?
That is certainly possible. One of the things that started, when you think back just about 9 months to the beginning of 2018, there was a lot of conversation about global coordinated growth. And that's when you really saw equity prices from November of 2017 through January of 18, they all started to go up in tandem. And I do believe when you get to the end of a bull market, that is a phase that we believe is still in front of us, where everything can go up. And earnings look like they're going to continue to grow. You have economies outside the U.S. that are going to start to benefit from the pickup in growth. One of the things that we see in front of us is the last throes of people putting money to work, because 0% interest rates or low interest rates in the developed world, negative in some areas, is really not a good alternative, especially if you get any sort of pickup in inflation. And if people start to perceive the inflation boogeyman is out there, it will cause a dramatic shift in where people allocate their money, and they will allocate it towards things that can grow. They will allocate it towards things that can appreciate in value, and that does not include cash or bonds. And there's still a lot of cash on the sidelines. There's still a lot of short-term money on the sidelines that has not yet come into this market. And we believe before the end of the bull market, you will get that coming in.
Okay, I understand. So the last leg is yet to come, the most dramatic. Let's turn the conversation to Europe. I've heard several people tell me that, not focusing on the tariffs, but the reason that we've got so much move on that is because Europe and Asia is not quite as strong as most people would like us to believe. What is your take on the European market now?
The European market, there's some opportunity if you just look at it on a valuation differential. The European markets are considerably cheaper than our markets. Are our markets expensive here in this country? Is our stock market expensive? By some measures, yes. But when you factor in the rapid growth and the earnings growth in this country, perhaps they're not as expensive. But Europe has issues. They have some structural issues. They have political issues, immigration issues that they're trying to deal with right now. And so I would argue that the European equity markets, that discount that they sell at compared to U.S. companies is a valid one. Now, can Europe begin to grow? And they are starting to grow their economy. Will interest rates go up in Europe? They will go up in Europe, maybe driving some money out of fixed income. But I think what Europe really has to do is Europe has to embrace the idea that if you want prosperity, it typically does not come from government edict. And you have to allow people to pursue their interests. And that's the real differential. Asia has a different set of issues, Asia being dominated by the Chinese economy, command economy. It's been a fast-growing economy. India is a fast-growing economy. You have lots of economies in Asia that are very rapid growers, and they also sell at valuation discounts. Some of those valuation discounts are because there's less rule of law or there's currency issues. The fact that many of the Asian markets have state-owned enterprises that dominate their stock market are bound to keep their stock markets at lower valuation. But if you look underneath those, you're going to find fast-growing companies, fast-growing sectors within those, especially within technology, which are quite attractive. So again, when you leave the U.S. and whenever you invest, you kind of have to look at not just the country, not just the region, but pick the sectors, pick the industries that have the most upside with respect to growth and have the most dynamic innovations taking place. And so I look at the world as being a large opportunity set. Valuation is one concern, rapid growth is another concern. The value of the US dollar is one that American investors have to always consider. Are you being rewarded for being in a foreign currency? And up until last month, the dollar had been strong, and it really takes the upside out of foreign investors if you get a strong dollar. Lately, the dollar has started to weaken, and so we're actually looking at some of these foreign markets that we had not been exposed to as being attractive. If the U.S. dollar starts to fall versus those currencies, it really opens up the opportunity set for investors to look internationally.
All right, so what I've got from the conversation so far is that the technology wave, which is fintech and in biotech, we're also seeing a lot of move in the blockchain, crypto world. That whole spectrum right there, emerging technologies in foreign countries is an opportunity. But one of the things that I had somebody in from Brussels, and they were very much the economist. And they were saying that France is the worst country of all of them when it comes to ability to find value in that economic sector. Italy will never go upside down. Greece will never go upside down, even though all the scary tactics that have come across, what happened with Cyprus and the Russians taking the money out of the banks, because Germany is not going to let Deutsche Bank go upside down, and Germany is by far the most stable of the entire spectrum of European countries. So high tech in Germany is really what I was able to glean from that conversation. I'm not trying to put you in a box, but I'm trying to get your feeling, because you mentioned high tech, Europe. There's a lot of ups and downs in Europe. And do you focus on where you think what country, what sector is going to be the best, or are you trying to use like an ETF approach, something that's got a aggregated growth model that moves in a group versus trying to narrow down into specific sectors, specific countries in those sectors?
Well, in our decades of experience, one of the things we have recognized and learned is that group, sector, country usually is responsible for as much as 75% of a move. So you start there. You do the broad, where is capital likely to flow? And then as you look for bottom-up investments, whether it's in Italy, whether it's in France, whether it's in Germany, remember that your overall capital flows may have absolutely nothing to do with an individual investment in a company. Now, when you talk about high tech in Europe, you're really narrow in that there just aren't that many high-tech companies being started up in Europe. And why is that? Because it's just not an environment that's conducive to going and starting up a company, starting up something, really taking risk, looking at a market where you are going to be able to lay off half the sales force, half the workforce, if that's what business conditions allow as you nurture a company from small to large. There are a lot of these decisions. You're going to go and you're going to start a company in a country that is going to allow you to do that, and is also going to, how best to say it, not take all of the upside out of it through taxation. And so you just don't get the level of innovation in Europe that you get when people come here to the U.S. to start companies. Asia is the same. There's so much fast growth in Asia. There's a lot of high tech that's being started in Asia because they just don't have those restrictions. You have the greater opportunity of enjoying your success if you're in an environment where the government, at least if nothing else, is out of your way. You know, they don't have to necessarily be supporting you, but if they're out of your way, you run a greater chance of starting something. And so innovative, creative technologies tend to migrate towards those locales. And Europe just has not presented itself as a viable option for the guy doing the startup, the tech. There are a lot of good tech companies in Europe that were started, but it's just not the same opportunity for an entrepreneur.
The companies that come through our show, the ones that I've noticed that you have some brilliant training going on in Western and Eastern Europe, but they tend to be migrating to more freedom in Asia.
That's right.
Singapore, and that's where I'm seeing. I mean, we had a blockchain dating app, and the guys were all German. They came out of Munich, and they ended up in Singapore. Let's move forward. Emerging markets. What are you thinking about that?
That goes back to that conversation of the dollar. The emerging markets tend to follow the opportunity to make money in emerging markets for a U.S. investor is going to be a function of the dollar. When the dollar starts to get strong, not only are those emerging markets not able to go up, but you have to have a faster growing profits in those local currencies, which may be depreciating versus the dollar, versus the profit opportunities here. We do like emerging markets. Many of them grow their GDP faster than the U.S., but also they have that dollar hurdle for a U.S. investor. One thing also to remember is that the world, especially in the emerging world, is structurally short the U.S. dollar. There is a tremendous amount of U.S. dollar-based debt that has been issued by companies and by governments in the emerging world. And a strong dollar works as a double whammy because they've issued foreign currency debt that has to be paid at a higher price at a later date. And that causes money to fly out of emerging markets. Emerging markets have to overcome a strong dollar, and that's just the simplest way of looking at it. There are fantastic, fast-growing companies in emerging markets, but as an overall asset class for a U.S. investor, the value of the dollar, what is the Indian rupee doing versus the dollar? What is the Chinese renminbi doing versus the dollar? Singapore dollar, Hong Kong dollar. The Hong Kong dollar being pegged to the U.S. is in a narrow band, but you just have to take that into consideration before you invest.
I'm going to keep this as brief as possible because we have very limited time with each other. Real quick, pockets on the emerging markets, because that's a big spectrum. It could be the Middle East and it could be Latin America. Favorite pockets?
The favorite pockets, Asia and its fast-growing technology-based economies are the most attractive. In some cases and in some cycles, you will get natural resource-based economies really going up. But right now, I just don't see a large driver for natural resource-based economies. I'd much rather be involved in tech. Latin America, from Venezuela to Argentina to Brazil, there's a lot going on there that makes us as investors rather just step back, let some of those geopolitical, let some of those internal politics take place, let some of those currency issues work themselves out. So we're not at all involved in Latin America. That doesn't mean it can't get cheap and become a trading opportunity, but right now I'd say Asia, focused in technology, rapid growing and innovative technologies are going to be the most attractive. You mentioned Eastern Europe earlier. Just Eastern Europe is very attractive in many ways because they have an educated workforce and they're willing to do a lot of programming. There's just a lot of technology that's being developed in Eastern Europe, but it's hard to invest in Eastern Europe as an international investor. Some of these companies are private and some of them are just service bureaus for large Western companies that have recognized there's a tremendous amount of talent, computer talent in Eastern Europe. And so we will look for ways to play that might be a US-based company or a global company that just has the ability to take advantage of these emerging market pockets better than others.
Now, Tony, we have about a minute left. I wanted to wrap this up with commodities. What are your thoughts in the commodities markets?
Commodities need, in general, fast economic growth. You have it in the U.S., but we're not a commodity-intensive economy. Faster picking up economic growth in the rest of the world will drive commodities. Commodities also need inflation data to start picking up. You are getting some of that. But in general, commodity investing is a cycle. Commodities have tremendous periods of opportunity, followed by tremendously long periods of dead money. And are we entering one of those periods of opportunity? It remains to be seen. And certain commodities are going to be better than others. When I say commodities need inflation, we've had inflation around the world if you talk about asset prices. Maybe not in commodity price inflation, but we've definitely had inflation in asset prices. And commodity-driven inflation could be around the corner. We're watching it closely. Again, that comes back to the dollar. For a commodity investor, if you've got a strong dollar, it's going to give you a headwind on your returns.
They got it. Tony, it's been great talking to you. I want to do this again. I know that we can start drilling down in each one of these four silos we spoke about today.
My pleasure.
Thank you. You've been watching CEO Money with Michael Yorba. Thanks for joining us. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.